peace. This is Red Pill Awakened, and today I'm going to explain the concepts behind promissory notes, money creation, and legal frameworks. I'll use a fictional character by the name of James to illustrate how the banking system and relevant statutes work together. James, like many people, needed a loan to buy a house. He walked into his local bank and asked for a $200,000 mortgage. The bank was happy to help. They presented him with a loan agreement, a long document filled with legal jargon. But the most important part was the promissory note. James, without thinking too much, signed it, promising to repay the loan plus interest over the next 30 years. Here's where the story starts to reveal something interesting. James thought the bank had just given him $200,000 of their own money to buy the house. But what really happened was something quite different. The moment James signed that promissory note, the bank didn't transfer money from one account to another or hand over bags of cash. Instead, they created a new deposit in James's account, $200,000, which didn't exist before. How? The bank essentially used James' promise to repay the loan as an asset. This process is allowed under a fractional reserve banking, where banks only need to keep a fraction of actual cash in reserves. The rest can be created as credit, or in simpler terms, new money. Under 31 U.S.C. 5103, legal tender in the U.S. includes all U.S. coins and paper currency, but in the modern banking system, credit has become a form of money too. When James signed the promissory note, the bank monetized it as an asset they could lend against. The UCC, Uniform Commercial Code, Article 3 defines James's promissory note as a negotiable instrument. This means it's a document promising payment, which the bank can hold or even sell to other financial institutions. James was told by the bank, "You now owe us $200,000 plus interest. You'll pay it back over time." But here's the catch. The bank didn't actually give James their money. They created it based on his own promise to repay. In essence, James created the money through his promissory note. The bank merely facilitated the transaction and provided the funds he promised to repay. This practice is common, and it's part of how money is created in the modern economy. The bank didn't take actual cash from its reserves or another account to hand over to James. They credited his account with the loaned amount. James, now growing curious about how all this works, starts digging deeper. He reads through the fine print, becoming increasingly uncomfortable with how the bank handled his loan. As James researched, he found out that the bank is legally required to disclose specific, critical information to him. Under the Truth in Lending Act, 15 U.S.C. 1602, the bank must provide the following: the loan's total amount, the interest rate or ARP, which should be transparent, any fees or charges associated with the loan, the repayment schedule showing the amount of each installment over the loan term, the total cost of the loan, including how much he'll repay in interest, his right to rescind the agreement, which means he could cancel the contract within a specific period, usually 3 days for certain types of loans. James wondered, did the bank really give me all this information clearly? James learned that under Truth and Lending Act of 1635, if the bank failed to provide him with all the proper disclosures, he had the legal right to rescind the loan. He could cancel the agreement altogether, null and void the loan, and possibly walk away owning the property without the mortgage attached. James started to suspect that his bank might not have fully complied with Truth in Lending Act. Maybe they hadn't disclosed all the fees correctly, or maybe they rushed him through signing without giving him time to understand his right to cancel. He realized, if they didn't disclose everything, this could be fraud. With this information, James sought legal help. His lawyer explained that if the bank failed to follow the law, James could challenge the mortgage contract. If successful, the bank would have to release the mortgage lien on his property, refund any payments he made under the loan, and potentially pay damages for violating federal law. James was excited but cautious. His lawyer told him about several people who had successfully taken on the banks and won, proving that their loans were based on fraudulent or improper practices. His lawyer, Red Pill Awakened, even gave him examples of borrowers who beat the banks. His lawyer brought up a famous case, Jesinoski versus Countrywide Home Loans Inc., 2015. In this case, the Jesinoskis signed a mortgage, but later realized they hadn't been properly informed of their right to rescind under Truth in Lending Act. The U.S. Supreme Court ruled in their favor, confirming that they had the right to cancel their mortgage even after 3 years. James felt empowered, realizing he could fight back if his rights had been violated. The second case his lawyer discussed with him was Miller versus Bank of America, 2009. In this case, a borrower named Miller discovered that her bank had misrepresented key facts about her mortgage. The court found that the bank had failed to disclose certain fees and had charged unauthorized costs. As a result, the court ruled in Miller's favor, forcing the bank to cancel the mortgage and pay damages. This showed James that even large institutions like Bank of America could be held accountable. And lastly, James's lawyer discussed Hudson versus Midland Funding, 2010. In this case, the court found that the lender had provided misleading information about the interest rates. The borrower successfully argued that the terms of the loan weren't disclosed in good faith. The court voided the contract and Hudson was free from the mortgage, keeping the property without further payments. James now understood that the law was on his side. He could challenge his loan if the bank hadn't been honest or hadn't properly disclosed all the details. It wasn't just about fairness, it was about fraud. James realized that many people fall into the same trap he almost did. They trust the bank without questioning the fine print or considering their legal rights. But armed with the right information, James could now confront the bank about their shady practices. He decided to investigate further, asking his lawyer to go over the documents with a fine-tooth comb. Sure enough, the lawyer found irregularities. The bank hadn't fully disclosed certain fees, and the repayment schedule was misleading. There were hidden costs buried in the loan that James had never been informed about. His lawyer prepared to file a claim, citing violations of the Truth in Lending Act and UCC Article 3. With the legal leverage, James and his lawyer went back to the bank. They pointed out the fraudulent practices and how the bank had violated federal law. Faced with overwhelming evidence, the bank had no choice but to back down. In the end, James's contract was rescinded. The mortgage was voided and the lien on his house was released. He kept his house, free and clear of debt. The bank, caught in their own web of deception, had to let James walk away with his property. James couldn't believe it. What had started as a stressful, confusing loan process ended with him owning the property outright. The bank had tried to trap him with their legal jargon and half-truths, but the law and James's determination helped him win. James's story isn't unique. Thousands of people across the country fall victim to banks that fail to properly disclose the terms of their loans. But with knowledge of the law and a willingness to fight back, James was able to free himself from the mortgage. The Truth in Lending Act, UCC Article 3, and countless court rulings protect borrowers like James from banks that act in bad faith. While the banking system can create money based on promises, it cannot legally trap people without fully disclosing all the terms. In addition to the Truth in Lending Act and UCC Article 3, several other laws and regulations protect borrowers from predatory practices and ensure fair lending. Here are a few. 1. The Fair Credit Reporting Act. 2. The Fair Debt Collection Practices Act. 3. The Equal Credit Opportunity Act. 4. The Home Ownership and Equity Protection Act. 5. The Real Estate Settlement Procedures Act. 6. Dodd-Frank Wall Street Reform and Consumer Protection Act. And 7. State consumer protection laws. These laws, together with the Truth in Lending Act and UCC Article 3, provide a comprehensive framework that safeguards borrowers from banks that may act in bad faith, ensuring transparency, fairness, and legal recourse. Here's a summary of statutes and codes in James's story. Truth in Lending Act, 15 U.S.C. 1602, requires the bank to disclose all loan terms, including the APR, total loan amount, repayment schedule, and fees. The Truth in Lending Act, 1635, right of rescission, grants borrowers the right to cancel certain types of loans within 3 days, and potentially longer if disclosure violations occur. UCC Article 3, Negotiable Instruments, defines James's promissory note as a negotiable instrument, which the bank can use as an asset. If mishandled, it can be legally challenged. If banks fail to disclose all key terms under the Truth in Lending Act, this is fraud in lending, the borrower can file for rescission and potentially walk away from the loan without repayment. This is Red Pill Awakened. I hope you enjoyed the story. If you're ready to take control of your financial freedom, I have a super bundle for $499, packed with resources worth thousands, all in one convenient stop. Plus, the $199 status correction package is still available. And if you've already purchased the status correction package, the $199 will be deducted from the $499, leaving you with just $300 to pay for the bundle. Other than that, it costs nothing to like, comment, and share. Let's spread the knowledge. Enjoy your Friday night, and I will see you next time.